chart.
Okay, sir.
Right. So we are looking at financial management.
Yes, sir.
And with financial management, we are acting as a financial manager.
Okay.
And the role of every financial manager is to maximize the wealth of shareholders.
Okay.
Right. So that is the main thing that we are talking about. Any other technique, any other concept that we tend to learn from here, the main role is to maximize the wealth of shareholders.
Okay.
So I'll just indicate that here. Just indicate that over there.
Yes.
Just pardon me, let me use a different color.
Okay.
All right. So the role of a financial manager is to maximize
Okay.
the wealth of shareholders.
Okay.
Every financial manager, including a student writing the financial management paper. So here you are a student financial manager, and your main role is to maximize the wealth of shareholders.
Okay.
Shareholders are individuals who tends to give their money by buying equity shares.
Okay.
But we have other form of financiers. They are financiers because they give us funds to be used in the running of the affairs of the business. So we call them financiers. In financial management, we have two main forms of financiers.
Okay.
We have the first one to be shareholders and the second one to be debt holders. So two main
shareholders and stakeholders.
Shareholders and debt holders.
Okay.
Right. They are all stakeholders. But
Okay.
when we talk about the two main forms of financiers, we have two main guys. We have shareholders and debt holders.
Okay.
Yes. A stakeholder is somebody who is having an interest in the company.
Okay.
So a shareholder can be a stakeholder. A debt holder can be a stakeholder.
Okay.
Because they are all having interest. If they do not have interest in the business, they will not give you their cash.
Okay.
They will not give you their money for you to use in the running of the affairs of the business.
Okay.
So they are all stakeholders. But we are talking about two main forms of or sources of funds, which we can get from equity holders and debt holders.
Okay.
And these guys who give us that money, we call them financiers.
Okay.
All right. So let me just indicate in there two main forms of financiers. A financier is somebody who provides you cash. Then you use the cash in the running of the affairs of the business.
Okay.
Right. So we have the first one to be equity holders.
Okay.
So that is the first one. We have equity holders. Equity holders are shareholders. We call them shareholders.
Yeah.
The equity holders, we call them shareholders. Then the second one, we have debt holders.
Okay.
Debt holders. The debt holders, an example of a debt holder can be, let's say, bank.
Okay.
So you can go for loan from a bank. The bank has financed you. You can go for cash from some shareholders who also call equity holders. So in financial management, we have two main sources of funds. Two main sources of funds. Two main sources of funds. These are recorded, so you can have access to it. Two main sources of funds. That means when you talk about source of funds, where you can get funds from, you can get funds from two main sources. That means that we have a lot of sources of funds, but we can categorize all the sources of funds under two main headings. We have a lot, but whatever you talk about can be classified under these two main. The first one, we have equity source. The second one, we have what you call a debt source. Any of the forms that you can make mention of a lot, they can either be classified under equity or they can be classified under debt source. So what are we trying to say over here? This is just an introduction of our meeting pertaining to financial management ICAJ. And we are saying that the paper is financial management. We are acting as a student financial manager. A student financial manager should note that the main of a financial manager is to maximize the wealth of shareholders. So the ICAG has come up with a syllabus entitled Financial Management. It is going to show you how to maximize the wealth of shareholders. But notwithstanding, before we show you the topics and how the topics will help you maximize the wealth of shareholders. It is important for you to know that in financial management, if you exist as a business entity, we have two main forms of financiers. The financiers are the individual who provides you with the funds. We have the equity holders, who also call the shareholders. We have the debt holders, who can be a bank, can be any other entity who tend to give you a loan. It can be a bond. It can be maybe a loan note. Any of the forms of what? Debts. Then you also added that we have two main sources of funds.
Yes, sir.
That is where we can get funds from.
Equity
We can get
source.
funds from equity source or from a debt source. And we are saying that we have a lot of topics in the ICG financial management syllabus.
Yes, sir.
Which is going to show you how to maximize the wealth of shareholders. So whatever you learn in financial management is geared towards how to maximize the wealth of shareholders. The word maximize means to increase the wealth. So let's take it from an angle. What do you mean by the wealth of shareholders? What are shareholders getting? Shareholders are paid dividends. So let me just bring that wealth of shareholders so that at least we can identify that. Worth of shareholders. The shareholder will not intentionally give you his money just like that. He will give you money used to start the business. Is it that he just love it to just give you his money? No, he doesn't just want to give you his money. He's looking at something, right? It can be one, the fact that he's going to receive dividends. So probably pertain to what management will decide. Either they want to pay dividends every 6 months or pay dividends at the end of the year. It can be an interim dividend or it can be at the final dividend. Interim dividends is when we pay dividends before the year ends, and final dividends is when we pay dividends at the end of the period. These dividends can be in the form of cash or can be in the form of what? Shares, giving you extra shares. Instead of giving you cash in the form of dividends, we can give you extra shares. And the second one is what we call capital growth. Capital growth. Sometimes a shareholder can decide to sell his shares if he realizes that the value of a share has increased. He can sell his shares if probably he bought 500 shares. Let's just look at this analysis. If he bought 500 shares at, let's say, 2 Ghana cedi, he bought 500 shares at 2 Ghana cedis, that will give him 1,000. If, let's say, after 6 months, it becomes clear that the price of a share has now moved to 3 Ghana cedi, then that means that he's going to get something like a profit. But that profit, we call it capital growth. So at the end of the period, he bought it at 1,000, but he can sell it at 1,500. That means that at the end of the period, by buying that shares of the company, he's going to get a profit of 500 for just buying and selling the shares outright. And some investors tend to do that. If they know for sure that the price of the share is going to increase based on certain indicators, they can just come in, buy the shares and sell the shares and go their way. In effect, how much they incurred in buying the shares compared with how much they are getting by selling the shares, the difference is their profit, and that profit is what we call capital growth. Right. So when you are talking about the wealth of shareholders, that is the benefit shareholders are going to get for giving you their money, for you to use their money in the running of the affairs of the business. So either you pay them dividends based on what management to conclude and the money available, they can conclude on how much and when to also pay the dividend. This investor who here is a shareholder can also get a capital growth. So the ICAG syllabus has a lot of topics. We have a lot of topics. It's just a syllabus for one paper, financial management, and it's having a lot of topics in there. But the topics you tend to go through is still looking at how to maximize the wealth of shareholders. So we will look at a topic called investment appraisal. So let me just talk about some of the topics. Topics in the ICAG financial management paper. Financial management paper, right? So we are looking at some topics in the ICAG financial management paper, right? The first topic we will look at is decision making. It's just the environment, the financial management environment, where we look at the types of decisions and what have you. So decision making. Now, we are saying that financial manager tends to take decisions. The decisions which he will take can be an investment decision. It can be a financing decision. It can be any decision which is related to working capital. Investing, financing, a working capital decision. Any of the forms of decisions can come up. But he being a position as a financial manager should be able to take that decision. But he's not supposed to just sit down and take the decision. There's supposed to be a lot of analysis that he's supposed to bring to bear before he conclude. Sometimes even add up the knowledge to experience on the field or pertain to the particular thing that he's looking at. Even conduct a market survey to get ideas of individuals, even involve the services of maybe non-executive directors who are very experienced and they have a lot of experience. You can just have a discussion with them, tap ideas from them, then add all of them, then decide on what he wants to do.
Okay.
Now, the decision making as a topic is still looking at how to maximize the wealth of shareholders. So you make decisions on items or issues which will maximize or increase the wealth of shareholders. You are not supposed to come out with decisions which will not lead to the overall goal of you as a financial management student. You can move from decision making as the first topic to that's the framework, the role of what financial management. That is the first topic.
Okay.
We move to the second topic, that is investment appraisal. And there hasn't been just a single ICAG financial management paper without seeing a question on investment appraisal. If you do not see investment appraisal, then it's not a financial management ICAG exam. Every sitting, you see that, right? Here, we want to decide on which project or which investment to enter into, which investment, which opportunity are we supposed to put our money into it. And we are looking at a project which will give us more benefit than the cost we are incurring. So we tend to learn a lot of techniques like issues of NPV, net present value, accounting rate of return, issues of internal rate of return, payback period, adjusted payback. These are techniques which we use to appraise investment. And appraise investment, you are looking at the in and out of the investment to see if you're going to be better off for investing into that project or not. You are concluding whether the benefit which comes with the project will outweigh the cost which comes with the project. And if it happens that the benefit outweighs the cost, then that project is a viable project. It's a project that when you enter into, you are going to be better off. And the financial manager is not supposed to just look at appraising investment and picking investment which are not going to be profitable. He's supposed to select projects which are going to give him a lot of profit that he can save some money to be used to pay dividends to those shareholders. He can save some money for payment of dividend. So the investment appraisal techniques that we are going to go through, that the two of us are going to go through, we are going to look at techniques, learning techniques that we can use to appraise investment. And the decision criteria is going to be that we will select projects which are having a lot of benefits than cost. Because when you're able to select projects which are having a lot of benefit than cost, that is when you can get something extra to pay your shareholders. Right? So it is a topic, investment appraiser. But how are you using investment appraiser to maximize the wealth of shareholders? You can do that by learning or having a mastery of that topic. And the mastery that you have in terms of that topic, you're going to use it to select projects which are really viable. Projects which are viable are most profitable projects. They are going to make you better off. So learning investment appraiser with the techniques will help you to maximize the wealth of shareholders by deciding on projects which will give you more benefit than cost, to the fact that you can save some maybe profits or you get some earnings extra to be used in paying shareholders. And the main goal of financial management is to maximize the wealth of shareholders. So whatever you learn in the syllabus, the financial management syllabus, we ask us, how is it maximizing the wealth of shareholders? How is it? So we are not just going to learn financial management. It should be geared towards how to maximize the wealth of shareholders. We will now move to talk about issues of WACC, weighted average cost of capital. Weighted average cost of capital. Weighted average cost of capital. Notably called by students WACC.
Okay.
Right. You see, whatever funds or capital that you go for, either equity or debt, create cost to you. You and I are aware that when you go for Fidelity Bank's money as loan, you pay interest on the loan. The interest that you are paying on the loan is the cost which comes with the capital. So any capital you go for creates cost. If you decide that probably you're not going to go for money from Fidelity Bank, would you have paid that interest? You wouldn't have paid that interest. So the interest you are paying aside the principal is a cost which has been created for you, having gone for Fidelity Bank money.
Yeah.
Now, if you also decide to go for money from shareholders, which is an equity source, you are also going to pay dividends. The dividends you're going to pay is also cost created to you for you going for money from shareholders. If you opted not to go for money from shareholders, would you be paying somebody dividends maybe quarterly or probably at the end of the year? You wouldn't have just worried yourself to be paying that money. So any form of capital that you go for creates cost for you. And the lower the cost it creates for you, the better the market value or the better the value of the company. So we are saying that in financial management, the greater the work of the company, the disadvantage it will be on the company. So here, the role of every financial management student is to look at possible ways of minimizing the work of a company. And that is what we are looking at. The essence of learning work is not to just calculate work. As some students are just happy, they calculate work. What is the essence of calculating the work? Looking at theory in terms of textbook and applying it to practice. If we turns out to be a financial manager, our role is to look at probably going for capital from somewhere, but we will opt to go for capital, which will give us a lower work. Because if the work of the company turns out to fall, the market value turns out to increase. That is what we are looking at. So the market value of a company, I just represent the market value with MV. The market value of a company is equal to the present value of the cash flows. I will explain present value. Present value is when we discount a cash flow, which is the future to today terms. So present value, PV, I'll just represent by PV. Present value of cash flows. Present value of cash flows divided by the work of the company. So divided by the work of the company. Right. So now let's give an example over here. If we are just making an instance, if the present value of the company is 500, and if it happens that the work is, let's say, 10%, if it's 10%, it's going to be 0.10. At the end of the day, we are going to get 5,000. So 500 divided by 0.1, that is 10%. 0.10 is 10%. That will give you 5,000. Now, let's look at the point where the value is decreasing. Because we are saying that in learning weighted average cost of capital work, the most important thing is that is on the part of the financial manager, is to look at a capital which its work is going to be lower.
Yes.
Because when the work is lower,
so can we say that the work is the interest?
The work, if it is only debt, that you have gone for, the cost that the debt is creating to you is the interest. But it can happen that you can also go for equity from shareholders, and it will also create a cost for you, which we call cost of equity. It can also happen that you can go for some funds from preference shareholders. It also creates cost for you, which we call the cost of preference shares.
Okay.
So any capital that you go from somebody to start a business creates a cost for you. And that cost, when you add all these costs by accumulating them, right, then that is what we get what you call WACC.
Okay.
So we have a lot of cost of capital that you tend to go for, but we tend to combine or group all of them together, and we give it the name, the weighting of the averages of the cost of capitals. So we can have a lot of cost of capitals. but we
Okay.
find the weighted average of all the cost of capitals.
Okay.
Right. So the role of every financial manager, which you and I are also part of it, is to look at any capital that our business will go for, which that capital that we have gone for, the cost creating to us is small. We want to go for capital, but the capital we will go for to be used in the run of our affairs should not create a huge cost to us. And how you identify that it is either going to create a huge cost or lower cost is by calculating WACC of the company. So I was trying to show you that the lower the WACC, the better the market value, the value of the company.
Okay.
So I indicated 500 divided by 0.1. That means that if I'm assuming that the WACC of the company is 10%, then overall the market value of the company is going to be 5,000. What if the WACC of the company turns out to be 5%? Instead of 10%, it has reduced to 5%. What would it be? That means at that point in time, the present value of the cash flow is still 500. So I'm going to divide the 500 by 0.5. So that's what I'm going to do by 0.50. Right. And this will give you 2,000. Let me just look at that. Let me just do the analysis. Pardon me, just give me some moment so that at least I can do that analysis and get it right. It appears I'll get rather 25,000. So I have 500 divided by 0.05. Okay, I end up getting 10,000 instead.
10,000, yeah, 10,000.
So I end up getting 10,000 instead.
Yeah.
So I have 10,000.
Yeah.
So I end up getting 10,000.
10,000. Yeah.
So you realize that as the denominator, which is the WACC, fell from 0.10, which is 10%, to 0.50. Oh, I've made it 0.5. Let me just correct that. It is 0.05, not right, 0.05. Right. So to give us 0.05. Right. So it is not 0.5, it's 0.05. So if you divide 500 by 0.05, you end up getting 10,000. So you realize that the lower the WACC, the higher the market value of the company. So every financial management or financial management student or financial manager is looking at, in fact, for the capital, we can't say we will not go for the capital. Probably you have seen a project which when you were able to get it done, you get a lot of benefit, but you do not have the capital. Are you going to sit down and say you don't go for any capital? You go for the capital, but you are to go for a capital which will not create a huge cost for you. So by learning WACC in the financial management paper, I've seen a lot of students know how to calculate WACC, but they do not know the objective for calculating WACC. The ICAG financial management syllabus is not given to you to just calculate WACC, just like that. But you have to look at the impact of the WACC on the overall market value of the company. So our role or our main objective here is to determine the WACC of a company, but that WACC of the company should be a lower WACC to end up maximizing the market value of the company. Right, that's okay. So I'll just be getting things done, just an introduction for the day, so that at least we can continue later on in that respect. So I'm just trying to, I just decided to just introduce it for you to see how things will be. The usual thing is that I'll share the document that we'll be using for our meeting to you in advance, so that you can even print it in advance, read through that sort of, so that at least we can just move as quickly as what's possible. I tend to